But when you retire, it changes to an income management process, new kind of wealth management with a purpose. So the retirement income management process has a few steps to it. The first step is purpose, envisioning. What makes you happy is really what kind of retirement are you trying to retire into? That's really what it is. It's definition of the retirement you're trying to provide for. The second step is to just identify today's risks, right? Like, and I think we are a little bit more centric on this than a lot of money managers. There are people that are out there like, look, this is just what's always been. It's how it's been. These are the tried and true rules. Just do all of this and it will be no different tomorrow. We think there's certain risks today that could be game changers. So we work very hard to try to identify the specific risks. But if you do identify them specifically, then you can solve them specifically and address them specifically. Instead of this, then you look at the solutions, specific solutions to specific risks, and you start to hammer those out one by one in the way your portfolio is constructed. And then you study the feasibility of it. You look at future projections, what that means. Now, we do a retirement roadmap, and we do that almost every year with each of our clients. And the retirement roadmap is just a visual study that just helps with feasibility and always looking at changing out the numbers and forward looking and seeing, are we on the right path, etc. That's feasibility. Those are the main risks. I wrote a report several years ago called Inflation or Deflation, America's Monetary System in Crisis and How to Plan for It. And this list of 5 risks was embedded in that report. It says you could buy all the stocks and mutual funds you want in the 2010s and 2020s. Buy all the best foreclosure real estate, which was going on back then after the great bubble. Stock up with piles and piles of all the gold and silver you want. And tell you, if you call this shot wrong, inflation or deflation, your plans could all be for naught. We were looking at that. Which way are we going? And even today we have stagflation. It's a combination of both. We're linked to this report as well as some other goodies. So in that report, I had a section here on the 5 greatest risks that I isolated. So there are 12 textbook risks to any management scenario, but I isolated 5 here that are particular challenges to baby boom retirement. So let's take a look at them. Number 1, market risk. The American, if not the global economy, will be frail and the stock market will be extremely volatile. That continues to happen because we've got the money printing, because we keep trying to iron out risk in the market, but we create more risk when we print money, and then we try to figure out where it's all going when the money printing stops. And we didn't have to stop. We could go forever until now we've hit inflation. And now we've got some trouble because the Fed's trying to cool that down and stop printing money, but we're wondering what's going to happen to all the stuff that used to depend on printing. So we still have a volatile market for starters. 2, tax risks. Historical increases in tax rates on businesses, working people, and retirees, with both state and federal government getting ever more ingenious about inventing new ways to collect tax revenue. That's going to be going on. This is for boomers and Gen Xers. Monetary risk. There's a serious possibility of hyperinflation or deflation. Which one? Call it wrong and you can lose everything you've built. How about that? I wrote this when we were having deflation. Now we're having inflation. You've got to understand both sides of that coin and work accordingly. We are currently in a stagflationary period. That means that money is becoming worth less and consumer costs are going up. And yet the Fed, in trying to slam it back down, is putting us at risk. Housing is cooling, maybe reducing. So you're looking at certain consumer costs increasing where money's becoming worth less, yet you try to go into holding assets, the traditional assets, and they're at the risk of crashing. That's stagflation. It's your dollars becoming less value and there's nowhere to invest because assets can be falling as well. That's stagflation. Okay, longevity risk. Human lifespan continues to increase with modern medicine. Therein lies a serious threat that a retiree could outlive their source of retirement funds if they live too long. We're going to be talking more about that in a minute. And number 5, health event risk. For those that have meager retirement assets